Yo, what's up, guys? Hope everyone's having a good start of their holidays. Um, I'm going to get right into it today. Um, I'm going to explain something what I like to call following the money or following mitigations, following what are they called? BFIs, big institutions, right? Um, Originally, I had this, as you can see, I have all this stuff marked out here. Originally, I had like a 14-hour video describing and explaining all of this stuff here, but I figured, you know what, today I'm just going to leave a little nugget and then I'm going to build on it later because I want to keep this, short, sweet, and simple and like a step by step process that you can follow within a series of videos instead of just one. So, yeah, let's keep it simple. So, basically, what I mean by um, following the money is following ranges and the mitigations of those ranges, right? So it's very simply put. By the way, happy holidays. So very simply put, a range, sideways price movement, initiation out of that range, right? BFI initiation, and then we have a mitigation of that range, right? They're coming back in, collecting more orders, grabbing more fuel to continue price higher, right? So I kind of have this four-step process written up here to remember, right? Range, initiation of that range, mitigation, and a continuation of that range, right? Um, so that's essentially what following these ranges or following the money means. However, we know this doesn't always happen. So, let's say we get a initiation out of this range, mitigation, which then creates this range, right? We have to move out of that range, but we don't see a mitigation of that range, right? We come short. So, what does that mean? Well, I don't really know what it means yet. However, we keep this in mind for later. Is this range here? Is this going to be used to continue from, right? Come back, bounce off of here, and continue, or is this going to be liquidity pulling power to blast through, right? And that's something that we'll have to see once the time comes, and combining it with the higher time frame, right? Like let's say we have a higher time frame swing down here, and then we have a series of ranges here. That was supposed to be unmitigated. Pretend that's unmitigated. Um, higher time frame is suggesting higher prices. We have our higher low and higher high. So uh, we have no reason to believe that it's necessarily going to continue lower. So, this will be potentially a point of continuation for the higher time frames, right? All right. So now that we have that established, we're just gonna just look through price, right, and show you, a live example of how this works. Alrighty. So let's start right here. Okay, so what do we just get rid of this here, get rid of that there, make it a little more clear. This guy too had this all ready and set to go, but that's for a later day. So what we have here is we have a move down, a range, okay, initiation out of that range, and then we get a mitigation. Okay, we even create these equal highs here, sweeping those highs, right? Creating a sponsored candle and a break out of that range. Now this was on a Sunday, so let's just pretend we have that going on here. Okay, and we get initiation out of that range, and then what's next? We have mitigation, right? With stacked lows here, with liquidity, right? Pulling price lower. Okay, so simple. And then even substructurally, the same thing happens, right? So we have a range here. We have a breakout of that range. Barely, it's pretty wicky, but we have it essentially. And then the next candle mitigates it, right? And then we have this range here. Remember, a range is just any sideways price action, right? Which also, on a higher time frame, a range is an order block. So just get that out of the way. Where was I? Yeah, so range, a break of that range comes back, mitigates it. And then we create another range, right? This happens all over the place. Get out of here. Break of that range, mitigates it, right? And then we have this range uh, is used for liquidity because, we're rejecting out this higher time frame here to go lower. It's just used as pulling power to push price lower, right? Now, on our way down, now we're creating this range, breaks through but doesn't mitigate. Okay, so right off the hop, you want to remember this is either a place of continuation. Oh, what did I just do? Hold on, guys, my bad. We have a, yeah, so are we going to reject off of there to continue, or is this going to be used for liquidity to just blast through? Anyway, let's continue here. Range again, same idea, breaks through, doesn't mitigate. Okay, keep that in mind for the future. Once again, same thing here. Range, no mitigation. So you can see already we're creating lots of reason for price, lots of cause for price to eventually, in this case, I would say breakthrough, right? Because this is the stacked liquidity here. It's going to break, used as, liquidity to break through as pulling power. Because remember, liquidity is like, I like to look at it like a magnet, right? So wherever the most liquidity is, price is likely to be attracted to it, right? So if we get like a break of structure and below that there's all this liquidity, it's almost as if the market like kind of like lets go and then that liquidity pulls it back in. So yeah, it's a little metaphor there for you. Again, here a range breaks through, wasn't mitigated, right? On top of that, leaving all this imbalance here. So this is a pretty good indication that all of this is going to get taken out pretty soon. We don't know when, but we're going to use that to our advantage. All right. So yeah, now we get a break of this. Let's zoom out. We get a break this higher time frame here out of this range. Righty? And look what happens here, right? We have a break, initiation out of that range, and a mitigation and continuation, right? And then within that, this goes like 3 layers deep here. It's the market inception, the matrix of the market. We have this one, this range, right? Initiated out of, comes back to mitigate. And then we had this one that was never mitigated, right? And now we've used that for an area for continuation, right? So I hope you guys are grasping this here. I hope this is making sense. This range, I already drew this one in, but anyway, that range as well. Let's dig in again down here, and even on the way up. That's a big move up here. Let's start here. You just follow the money, guys. Follow these ranges. I'm not worried about showing you like where I'm gonna get, where I would consider getting into the market. so on and so on. I just want to show you what it means to follow these mitigated ranges. Follow the money and understand what it means when they are and what it means when they're not, and how to use it to your advantage. Okay. Let's just keep going here. We have this range. Okay, we have a break of that range, comes back and mitigates that range. Okay, the equilibrium-ish point. I'll grab a range box here, right? Roughly, right? And then within there as well, we have ranges. We have this one, right? Comes back in, mitigates it, right? I bet you that probably levels up almost perfectly. Yeah, just about perfectly lines up with the equilibriums of both of these ranges, right? So that's an added confluence. Let's keep going. We have this range here, breaks above, and actually does get mitigated way over here, right? As you can see, comes back, mitigates it. Alrighty. The range here does get mitigated, so using that for the future. Range here, breaks above, comes back, mitigated. So you guys get the point here. Basically, what this ties into is oopsies, Blackwatch's video, Brian's video of what's the word? Order flow, right? Expectational order flow. That's what we're looking at here. But also, it's about understanding why these ranges or price comes back into these ranges and what happens when they don't, and kind of give you a bigger picture, right? Because it's easy to focus, let's say on this range here, right? And say, okay, well, we have move down, right? A range, right? We have a lower, what is this? A low, higher, and then a lower high. We have a break of that. We even have a break of this structure. So, okay, well, we're expecting a lower high, but you didn't take into consideration, number one, the higher time frame bias, and along with that, this range, right? What about this range? This was these two actually. This was the range that was to be mitigated, right? So this was actually the lower, damn, no, the higher low, and then the higher high, and then what do we expect? The higher low to continue higher, right? Get it? Yeah, we just keep going. Just give you examples. Another range here, breaks above, comes back, mitigates it, right? It doesn't always have to come to 50%. You know, for me personally, if it's just a range, not a sponsored candle, if it's just a range, I'm just going to be looking in this top, top half. Let's clear this up. To me, anyway, personally, I'll consider that as a range mitigation. Let's say there's a sponsored candle down here. That's fine. I'm still looking for that to be mitigated, but I'm understanding that this range in itself has been essentially mitigated. Right? So just keep following price. Keep drawing in these ranges, sideways price action, and watch how it breaks. This one breaks slowly, doesn't get mitigated, really. It just breaks out slowly. So this alone right here, this low momentum after this low, shows me that this low is weak. This is a weak low. All right, because we don't have a lot of intention out of this range, right? I don't see the BFI saying, okay, we want to get in here and push price, higher. I mean, yeah, that is what it does. It does go higher, but not long term, right? As you can see, it comes through and it just easily blasts right through. It doesn't even reject off or anything. So that's what I would consider a weak low. And the same goes for, you know, a weak high. This range here, same idea, kind of slowly breaks up, get a sweep, and then a break. All right, and then we get, just keep following it, keep following the ranges. Get this range here, right? Breaks, doesn't really mitigate it. It kind of does technically, but also keep in mind, hope this doesn't get too confusing, but we had a break here. Keep in mind this range, right? This is unmitigated here, right? So this is potentially a price or a point of price that we want to look at later. Also have this order block here slash supply, or sorry, sponsored candle. So that's a good point of interest for later. So yeah, guys, just keep. This is just one thing I wanted to show you guys because I think it kind of gives you a clear direction of the market as well, right? If you connect it with the higher time frames, and it kind of just gives you a, how can I say, a flow of the market. You kind of get into the flow of the market right here, right? And then you understand why, you start to understand why certain ranges get blasted through and others are used to continue or reverse. All right, so this guy here, we get a sweep. Now we get a sweep here. Okay, why did we get a sweep there? Well, if we look here, we have this range, this bigger range, right? Or maybe actually this one, this range here, right? We get to move up and then we come back down to mitigate it, right? It's about combining also the higher time frame, bigger ranges together as well, and understanding where these price rejects off of. Because remember, smart money concepts, this is facts. We're not trading randomness here. Every single point of price happens for a reason. There's no random action here. So once you start to connect all the dots here, it makes a lot of sense, right? Just a couple more examples, and then I think you guys get the point. But just in case, we have move up, initiation, mitigation, continuation. That's it. Just keep following these ranges, and you're gonna notice this all over the place. Right? Move up, come back, boom. And then understanding the ones that don't, understanding the ones that don't get mitigated are gonna be used for later price action. So yeah, anyway, guys, I hope that helps a little bit. Like I said, there's a lot more I wanted to dig into here. I was gonna go over some trades as well, but I think it's best that I just drop a little nugget here, since this is a big part of the way I look at the market and how I trade, and then I'll just slowly combine all these confluences, I guess you could say, together at the end of the day to make cash. So anyway, guys, hope that helps. Ciao.